I don't need to tell you, do I? All right. So we're looking at the same chart that we were last week when we were going through support and resistance. So just a quick recap of what we said last week. We just talked about why the market moves up and down, and we talked about what constitutes resistance and what constitutes support. And we just slightly touched on how we would use that little bit of information to try and make profitable trades. So I might just go through a little bit more about, or just go over again, how we would use support and resistance in order to make a trade, a profitable one that is. So like we were saying last week, that what this market's doing now is what's called ranging. It's just bouncing between resistance and support, resistance and support. And when it's doing that, while ever it keeps doing that, although you never know when it's going to change, you can easily just place a sell order here, make profit, buy order here, and make profit. Of course, this is doing it in hindsight, so we know it's bounced quite a few times. But as we can see here, this time, if you'd have placed a trade here, you could have taken some profit if you'd have been watching what was going on. But if you just set a take profit up here near resistance, we would have missed it. And then, as we can see, it's broken through support since last week and it's continued on its way down. Now, so I guess that's enough to make, the way I look at trading, just from a numbers technical point of view, is the market can go up or the market can go down. I mean, it can go sideways, but if that happens, you don't make money, you don't lose money, so that doesn't count. So really, up or down, without knowing anything at all about trading, you would think that would just give you a 50% chance of getting it right. And it does, of course. The whole mind game and the mindset, risk management, all that comes into it to make it a little more difficult than that. But just looking at the numbers, you got a 50% chance of getting it right anyway. So just knowing what resistance and support is, and like with what the market's done here, it's bounced off support, bounced off resistance, it sort of bounced, but then it's broken through support, but quickly came back again, bounced off resistance, bounced off support. So already we've got a pattern forming. We've bounced off support, bounced off resistance, bounced off. So let's say we just watch the market, and by about here we've realised that the market's just ranging, and we've got strong resistance, strong support. So right about here we place a sell order, and we could just place a stop loss about here in case the market went the wrong way on us, and we put our take profit down here near this green line just before support. And in hindsight, very easy, the market came down, we would have taken a nice profit there. I think there's quite a distance between these two, so there's 20% difference between those two. So if you're doing a 10 times leverage trade, placing a trade here, taking profit here is pretty close to 200% profit, which is obviously quite nice. So that little bit of information on support and resistance, that's going to tip that 50% chance in our favour. How much, I don't know, but if you just know that there's a much, so like if the market's here and we don't know about resistance, we don't know about support, and we wouldn't know right here, we wouldn't know whether to place a buy order or a sell order, or or a long or a short. That's just a different terminology for it. But if we placed one, we should have a 50% chance of getting it right. Now, because we know what resistance is, and we look over here and the market's been bouncing off resistance, we know that there's a better than average, like that, a better than 50% chance that the market's going to bounce off resistance and come down. So if we know that there's a better than average chance that the market's going to turn around and come back down again, and we place a short order, then that's obviously gives us more than a 50% chance of getting that right. And the way I explain what I do with trading, I'm going to make it sound extremely simple so that basically everybody should feel like they can win in the markets. Later on, I'll get a bit more in depth on why it's not as easy as it sounds. But from a technical standpoint, I think trading is extremely simple. We let our heads get in the way a bit though. But, you know, you only need to win more than 50% of your trades and you're a profitable trader. You actually don't even need to win that much, but we'll get onto that as well. That's another whole lesson. So, moving on, of course, the whole idea about technical analysis is to take that 50% chance of getting it right or wrong and increase that as far as possible. So we've already increased it a bit just by knowing what resistance is. Now, what we're going to go through tonight is the actual candles. We talked about exactly what the candles are a little bit last time. And depending on not just whether they're going up or down, but the way they're grouped together, how long the skinny part, the wick is compared to the body, all of those things can tell us a lot about what the market's doing and give us an even better chance and increase those odds further in our favour. So I'm just going to, I didn't want to just use a PowerPoint slide because then it's just like a perfect representation of everything. And it's never going to be perfect like that in real life. So I just sort of use a real chart, but I just want to zoom in a bit. Now, just to recap on exactly what the candles are. So each one of these red or green lines is what they call a candle. And depending on the time frame that we're on, that's how long it takes for each candle to play out. So we're on a 4-hour time frame now. So this red candle, it took 4 hours from the time that red candle started until the next candle, until it stopped and the next candle started. So just prior to this red one, we've had this green one. Green means it's going up. And the top of the green, not the top of the wick, but the top of the green body is where the market was when that 4-hour time period closed out. So then straight across from there, most of the time, is where the next candle starts. And so it started there and it's gone down. At some point, it's gone all the way down to the tip of that red wick there. And then it came back up again. That's all we really know. It could have gone down to here, back up, down to here several times. But when that 4-hour period finished, it was right there at the bottom of the red body. Now, so what else can we determine from that actual wick? Okay, this is the one we're looking at. Okay, so there's basically no wick on the top side. That means from the moment this candle opened, the market only went down. Now, if we have a look at this red candle, when this candle opened, at some point, the market went up a little bit first and then came down. But on this one, there's just a tiny little tip there, but basically from the moment this candle opened, this 4-hour time period started, the market just moved down. So we know it wasn't indecisive, it didn't go up and down, up and down. From here, it just went down. Okay, so that's useful information. But what I want to go through now is different groupings. There's quite a few, and I'm not going to go into very many of them at all, just a few tonight. And this red one is what we call a bearish engulfing candle. So what that means exactly, let me get rid of that yellow line. So we've got this green one, and it's done its thing and played out. Then the next candle, this red one, obviously it went from green to red, but because the main part of this candle is much larger, or even just larger, but much larger is better, much larger than the green one. So from the top of the green to the bottom of the green is much smaller than the top of the red to the bottom of the red. So because it's red, it's going down. That's why it's bearish. And it's engulfing because it's much larger than the green one. So it's engulfing. A bearish engulfing candle is a good indication that the market's going to continue to move down. We don't know how far, but, and as we can see here, this green one, we've got the bearish engulfing, and then the next candles continue to go down as well. And then it's gone up a bit, but then it's gone down. And if we have a look, the market has generally continued to go right down to support. So in this particular case, it's done exactly what we would think it should from a bearish engulfing. It's continued to move down. If I just shrink this up a bit. So we've got our bearish engulfing, and the market's still going down, up, down, but it's generally continued right down. From this point, it's continued down until it's got down to support. So on its own, a bearish engulfing candle gives us one indication that the market could start going down further. Like a bearish engulfing candle means it has gone down this far, but it's also an indication that the market is likely to continue to go down further. That on its own is definitely not enough information to go and place a trade, but it is one nice little indication. And the fact that this has happened right on the resistance line gives it a lot more strength as well. So already we knew we had resistance and support. The market's bounced off support, and it's continued on up, and it's got up here to the resistance. So we're hoping that the market's going to bounce off resistance and come down because we want to place a trade there. But if we just placed a short order, you know, we've still got better than 50% chance of getting it right because we know there is resistance here. So there is a good chance that the market will bounce down. Okay, but if we wait until we also get this bearish engulfing candle, now we've got two things indicating that the market's going to go down. The resistance, that's going to push the market down. So that's one thing indicating. And the bearish engulfing candle itself is another indicator. So now we've got two things indicating that the market should go down. So I can't tell you how much of a chance that gives you of winning, but it's a little bit better than it was before. So we started out 50-50. We worked out where resistance was, so it's a little bit better than that. Now we've got a bearish engulfing candle, so the odds are a little bit more in our favor again. So that would make for a much, you have much more confidence in your trade if you've got two things indicating it. Personally, I like to have at least three things indicating that the market's going to go one way or the other before I trade, but not everybody does. A lot of people will just use support and resistance. You know, they're sort of people that don't want to spend hours and hours in front of the screen. So they do a quick analysis, they work out where support and resistance is. The market may be in the middle here somewhere, but they'll come up here near resistance. If the market's moving up, even though it's only in the middle at the moment, they'll just place what's called a sell limit order here, which means that when the market does reach that figure, it will automatically place a trade. So you don't actually have to physically do it yourself at the time. You can set one there ready to go when the market does reach it. And that way they can be at work, they can be asleep, whatever. The market will reach that. It'll place that short order. And then, you know, hopefully the market goes down and they'll have a take profit down here somewhere set as ready as well. And that'll be all good. Of course, the market's not always going to bounce off resistance. It could come up here, activate that sell limit order, and then it could just continue to keep going up. So they'd take a loss on that trade. But, you know, that's a very hand-free way of trading. But if you want to spend a little bit more time and be more accurate, you wait for that bearish engulfing or one of the other indicators, one of the other types of candles that I'm going to go through now as well. So does that make sense, guys? That, you know, resistance puts it in our favor a little bit, waiting for that bearish engulfing gives us an even better odds. That makes sense, doesn't it? Yep. Okay, so that's bearish engulfing. We have the opposite as well, which is like this green one. So we've got the red one and then the green one, because it's moving up, it's called bullish. So this one's a bullish engulfing candle, which simply means the market's going to go up. So if we want to have a quick look at that, the market's come down here and it's bounced off support. As soon as it's done that, we've got a bullish engulfing. And no surprise, the market's continued right up to resistance. And then we've got a bearish engulfing on resistance. And surprise, surprise, the market comes all the way back down to support. So, as I said, it's, this is all in hindsight, but you can see that that's played out exactly how you would expect based on that little bit of analysis that we've done. So that's bearish and bullish engulfing. What else can I find here? Haven't really prepared. I'm just trying to find candles to see.
An evening star back there, wasn't there?
Yeah, it's on my list too, but
right there.
As I said, it's always hard to find a perfect one, but I'm going to look at this green one here that's got no body to it at all. What would that be called, Des?
The Doji.
Yep, I'm just choking.
Which basically just means indecision.
Thanks, Des. I'm just going to explain why it means indecision. But so when we've got a big green one, it means the market's going up. The market's going up because there's a lot more people buying Ethereum than there are selling it at the moment. So that pushes the price up. Then we've got the red ones, the bigger red ones, the bigger the better. Just means there's more people selling Ethereum than is buying it at this price. So that pushes the price down. When we have a doji, like this one, it can be red or green or any other color you like to make your chart, but it doesn't matter which color it is. It just means, and in this case, when this 4-hour time frame started, the market's moved all the way up to here at some stage, the top of the wick. It's also gone right down to here at some stage. It could have done that half a dozen times, who knows? But when it finished that 4 hours, it was right back here where it started again. That simply means that we've got an equal number of buyers and an equal number of sellers. So, you know, they're waging this little war, and it was just a stalemate, basically. So the price at the start and the end of that 4 hours ended up being exactly the same. So in this case, you know, we've had a couple of red ones, the market's moving down, then we've got the doji, which is indecision. If you get one of those, you might want to keep an eye on it because it may mean the market's going to change direction, but as we can see, it didn't. So, you know, you need more confirmation than just that, but the market's been steadily moving down, and all of a sudden we've got 4 hours where the market goes nowhere, up and down, but moved nowhere. So there's a bit of indecision about whether it's going to go up or go down. So, you know, we might want to pay attention and see what happens on the next candle, which was, you know, it ended up coming down further. What we can often see is this one here will do. So this one here, even though the body of the candle is a little bit bigger, would still be a doji. And the market's gone up. Then we've had the doji, which is indecision. And then we've had the red one coming down. And so in this case, the doji is sort of indicated when the market stopped going up and then started coming down again. In this instance, it just continued to come down. So it didn't really mean anything much at all, but nothing on its own means a lot. We need a few of these factors, these indicators to line up to tell us more about it. But that's what a doji would mean, was indecision. And that's why, simply because the buyers push it up, the sellers push it back down, and they end up the same again. Any questions on dojis? There's not much to them. So now I better move on to morning and evening stars for Des, because he likes them. I've just got to find the best example of one here. Which one were you looking at before, Des?
Oh, can't see it now. You've gone a bit smaller. Or you've moved it.
That's all right.
Hang on.
I just want to find a good one so it makes more sense. And I want to find one at the top of the market. So okay, what we're going to look at now is a combination of 3 candles together. And it's going to be the red one, this green doji one, and this green one here. And this is what they would call an evening star. Which way is it? Evening or morning?
Morning star.
Morning.
It's bullish.
Yeah. So the market's come down, indicated by the red one. Then we've got a doji, which indicates indecision. And then straight after that, we've got a big green one. Now, the big green one is bigger than this one and this one, so that's also a bullish engulfing. It doesn't have to be a doji in the middle. It can just be a smaller candle of either color. But the key factor is that the red one's big, the one in the middle is small, and then the green one's big, which forms a morning star constellation. And that's just, these ones are an indication of market reversal. So the market's been coming down. We get the morning star constellation. I always say constellation, don't worry, but the morning star pattern, and which indicates the market direction could very well reverse, which it's done, and then started going up. And then obviously we have just the opposite if it's up the top, and we have a big green one, a little one, and then a big red one. That's just an evening star configuration, meaning the market's going to turn around and come back down again. Anything else we should add to that, Des, do you think?
Only way I remember them is the evening star. I remember that being a red one for being a sunset, so it must be red. That's the only way I can ever remember it.
Now, it doesn't, on that note though, like I remember it because evening star, it's up in the sky. I don't know why. It doesn't really matter what they're called. You don't need to remember what they're called. You could call them a purple people eater configuration. I don't care, but as long as you understand what they mean.
What they do.
We've got the big one, little one, and the big one, just indicating that the market's changing direction. So if the market's coming down and we get that, it could very well change direction. If it's up the top, it still just means the market's turning around.
But the third candle always has to be the largest of the 3 candles.
Well, it doesn't really have to be larger, although you're right, it's preferable. If the green
if you
one
look
should,
back,
yeah,
if you go back from where you are there, 1, 2, 3, if it wasn't larger, you could call that an evening star, but it's not
yeah,
because
that's right.
it's not larger.
So the key point of what Des is saying there is that remembering we're looking for a pattern that's telling us that the market's going to start to go up. Now, if we've got this red one here, and then we've got this little doji, and this green one only came this far up, you know, that could very well just be the same as this here. So we need a strong indication that the market's moving up. So it's been moving down, then there was indecision, and then there's a strong movement up indicating that it has reversed. So I like to think of it, it needs to be, this green one needs to be at least as tall as this red one, but preferably bigger, meaning that the market's just strongly going the opposite way to how it was just 2 candles ago. Just on that note, Des, the problem is if you get one that's too big, because we like to place our trade after the candle closes, but if this one's a huge big one and comes right up to here,
yep,
now we're already almost at resistance, so we don't want to place a buy order. So this one's just perfect though. It's a bit bigger than this one, just there. So what we would do, straight after that, we'd probably put a buy order in here, just after this candle closed, and you know that would have worked out okay. But good point. Thanks for that, Des.
That's what I'm here for.
Yeah, for sure. Honestly, I've been trading a lot longer than Des, but he pulls me up on my technical analysis quite often.
A lot more successfully too, I might add.
I need to rub it in. But the point, there's 2 points there. One, having a community of people there with you is going to help out a lot. You know, you just can't learn it all on your own. And the other thing is you can't do up an analysis on a chart. And, you know, if I did an analysis and Des did an analysis and Rod did an analysis and they're all a bit different, who's right, who's wrong? Someone may be wrong, but I mean, and someone may in hindsight be right, but there's no one exact way to look at it. There's obviously, it's not that simple. So having a few different viewpoints kicking in definitely helps to keep you on the straight and narrow.
Yeah, it's good to bounce things off each other.
What can happen is, let's just come back to our original bit of support and resistance here. Okay, I've drawn in support and resistance, and I've convinced myself that, you know, there's strong resistance, there's strong support. So I'm going to, you know, place a buy order here because, you know, I think it's going to go up and it doesn't. But if we come along here, you can see that the market is sort of now starting to trend down. It's broken support and it's coming down. But I might be wanting to place a buy order because I'm in the mind frame of what I was doing before. And even though it breaks through support, I might still think, okay, well, there's new support here. Go and place a trade. And the problem there is I might be influencing my technical analysis by what I want to happen. Not because that's what the chart's telling me, but because I've allowed my bias in my head to influence how I do my technical analysis. And then that's a bit of a trap you've always got to be aware of. So having more people, you know, doing their own analysis and sharing that, which is what a lot of us do, and definitely helps to keep that in check as well.
Mindset is the hardest thing about trading, 100%.
Oh, like I was saying, and I'm going to do another lesson when we get into that, but trading's so simple. Market can go up, market can go down. So that's 50% chance of getting it right. If you know support and resistance, the chances of winning is greater than 50%, so you should make money. just knowing that. But obviously, we all are smart enough to know it doesn't pan out quite that simply. But that is the technical analysis is not really technical. Once you get into it, well, me and Des learned it. That should prove a point. Sorry, Des, but
True that.
it's, as Des said, just being able to stick with your technical analysis, do it without any bias, and not let your emotions get in the way. Just for a quick example, when you trade in profit and the market's moving up really nicely for you, you might get greedy, and you might think, hang on, I'm going to move my take profit further up because I can make more money here. And then it just doesn't quite hit it, and it comes down and you miss out altogether. So you can miss out on profit because you get greedy. And sometimes, you know, I might see the market. It's a bit of a sort of a morning star configuration here. So I might have said, okay, well, it's sort of broken support, but I think it's bouncing back, and I've got that morning star. So I'm going to place a buy order here, and I'm going to put a stop loss right down here, just to make sure. I wouldn't do that, but I'm just trying to make a point. And then the market doesn't go up, it comes down, and I'm getting into drawdown, and my emotion this time isn't greed, it's scared. I'm scared of losing money now, and I can see this trade going into loss. Even though I've got my stop loss way down here, I'm going into more and more loss, and I go, oh, I don't want to lose this money, so I can't afford to lose any more. So I close that trade out right here, and then what happens is the market comes down here, turns around just before your stop loss, and then shoots off up into profit. And you've actually taken a loss because you were afraid to lose money. So the point I'm making, I guess, is you do your technical analysis, you put your stop loss where it should be, and don't tamper with it too much.
That's
you got to trust that you've done the right technical analysis. Sometimes that works, sometimes it doesn't, but you just let them play out. And in the long run, if you do know enough about your technical analysis, it ends up in your favour.
I took a big loss the other day because I thought I didn't put a stop loss in. Well, I did. And then I went to move it, and I thought, I'll come back to this, and I'll check this again later on. And that was one of those big candles there somewhere. I came back and it had wiped me out, liquidated.
Yeah. So you can, apart from the fact that you can get the trade wrong, or the market doesn't do what you want it to, you can also lose money just from simple clerical errors. So, you know, you can forget to place a stop loss. So instead of taking a $50 loss, you wake up in the morning in $700 drawdown. So that would be what I mean by clerical error. You just forget to put the stop loss in. You know, some of us are using EA softwares to trade with as well, which just, if you don't know what they are, they do all the trading for you based off the parameters you input. So it'll place the trades, put the stop losses, take profits, close them, open new trades. It does all of that. But you've got to input the parameters you want it to use, and you might put in, you know, the wrong trade size or something, which is just too huge for the size account you've got, or just some silly clerical error. And I've done it myself, just made silly little errors, which has actually costed me money as well. So check, double check, and triple check there as well. Okay, we've got one more candle formation that I want to go through tonight, and this one should do nicely. This little red one here. So no real wick on the bottom, small body, and a big wick on the top. That's called an inverted hammer. So it looks like a hammer, obviously. And obviously we've got the ones down the bottom, like this green one, that's just a normal hammer. And what's this showing us? If we just have a look at what the candle actually shows us, that the green one finished here, the red one started here, And at some stage during that 4 hours, the market's pushed right up to here. So there's been plenty of buyers, pushed the market right up to here, but straight away, the sellers have pushed it back down to here. So that's showing us that the buyers tried to buy, but once the market reached here, the sellers became stronger than the buyers and quickly pushed the price back down to here. So that's a good indication that the market's going to go down, because the market tried to push up but couldn't maintain that price, got pushed straight back down, all in the space of one candle. So that's an indication that the market's going to go down. Obviously, the reverse is the sellers have tried to push the market down low, but the buyers quickly pushed it back again, and that indicates that the market moves up. And in these two examples that we've found, this hammer formation candle, it sort of occurred at the bottom of the market on support, and it's quickly, straight after the hammer, the market has gone up. I mean, it's gone down and up and down and up, but generally it's gone up. And then we've got a hammer here right up on resistance, and after the hammer, the market started to trend downwards. So that's not a coincidence either. Okay. So, and we've got this hammer and this inverted hammer all occurring on resistance and support. That gives it more, more weight. You can sort of trust in it a lot more than that. Plus, straight after this hammer, we've also got, a bullish engulfing. So that's another good indication that the market's strongly going up.
There's your three indicators there.
So we've basically got three things there. We're on support. We've got a hammer. We've got a bullish engulfing. As I said, I like three things to trade, so that would be a good trade. And this, so if I waited for the hammer, that would only be two, but then I got this one. So by here, I'd be saying, okay, this is a good place to put a buy order. So when this candle closed, put a buy order, and look what happened. The market's dropped right back down to here. This is where you got to not get scared, because if I placed a buy order here, where I place the stop loss, and we're going to get into this more next week probably, would be just below the most recent low point. So I would put my stop loss right down here. We'll get into why exactly another time. But so when I put my buy order in here and the market started dropping, this is where you have to trust in your analysis, because it's come back down fairly close to where the stop loss is, but it didn't. And then it ended up running all the way up to resistance. So if you'd have got scared here, you could have taken a bit of a loss and missed out on a big profit. Any quick questions on those, guys? There's literally dozens of different candle formations, and I do actually have an ebook all about candle formation. So if anybody wants to grab a quick copy of that at some stage, just let me know. But they're the main ones probably, I guess, that I mostly look for. Any quick questions there, and we'll call that recording done. All right, quick question for you, Zoe. When I first found out, and it does seem pretty basic to me, but I clearly remember when I first found out that, like this hammer, it meant that there was people buying in the market, buying, but nobody was willing to, to buy any higher than that. So the sellers pushed the price back down. When I learned that the shapes of all of these candles were simply dictated by supply and demand, or buyers and sellers doing their thing, that really opened my eyes up to the fact that, you can literally just see how many people are buying, how many people are selling, just based off these candles. And that was a real eye-opener for me. I guess I'd never really thought of it before, so it made this technical, crazy-looking chart make sense,
Okay.
All right, well, I'm going to press stop.